We are seeing the early stages of a rare and powerful financial phenomenon known as the scissors effect, a dynamic where revenue expands rapidly while costs simultaneously contract, creating a widening jaw of profitability that does not just arrive gradually, but explodes onto the balance sheet. This report serves as your blueprint for understanding the violent repricing that lies ahead, cutting through the fear, uncertainty, and doubt to reveal a company that is not struggling to survive, but is instead fighting a battle of perception against a market that is not yet priced in its structural transformation. The most critical driver for the bull case is this scissors effect, specifically the revenue jaw, which is trending aggressively upward, driven by a strategic shift that prioritizes quality of revenue over mere quantity of units sold. When we analyze the January 2026 delivery numbers, we see that they were not just random figures, but a confirmation of this strategy, specifically highlighted by the delivery of approximately 17,646 units of the ES8 model alone. This is the game changer because the ES8 is a high-margin vehicle with an average selling price of approximately $55,000, meaning that this single model is effectively paying the bills and driving substantial gross profit, even if total headline delivery numbers fluctuate. Furthermore, we must consider the Firefly factor, as the new sub-brand is being positioned not just as another car, but as a vital margin protector for the entire ecosystem. By marketing Firefly as a premium lifestyle product, complete with custom liveries and utility as a kid hauler, NIO is ensuring that it protects its profit margins even on smaller, more affordable vehicles, preventing the margin dilution that typically plagues automakers when they move down market. The second half of the financial catalyst driving this repricing event is the OPEX jaw of the scissors effect, which is trending downward and creating the widening gap that leads to profitability. Driven by management's disciplined decision to cap R&D spending at approximately 2.5 billion RMB or $350 million per quarter. This spending cap is a signal that the heavy capital expenditure phase, the era of aggressively building factories, deploying thousands of battery swapping stations, and funding massive chip design projects, is largely finished, allowing the company to transition into a period of execution and refinement. We are seeing the results of organizational restructuring and the implementation of a harvest mode discipline where every single dollar of new revenue flows faster to the bottom line rather than being consumed by bloated overhead. The result of this discipline is breathtaking when you run the numbers, as our internal napkin math suggests that NIO likely hit operational break-even in January 2026, with gross profit coming in at approximately $250 million against operating expenses of roughly the same amount. When this reality becomes official in the upcoming earnings report, the short thesis that relies on perpetual cash burn will collapse instantly, leaving those betting against the stock with no fundamental leg to stand on. This invisible shift toward profitability is the silent killer of the bear case, as the market is still pricing NIO as if it were burning cash at 2024 levels, ignoring the massive structural improvements that have aligned costs with revenue to create a sustainable, self-funding business model. The disconnect creates fear, hesitation, and emotional fatigue among retail investors, and history shows that these emotions usually peak near inflection points, not at the start of declines. What is being overlooked is that NIO has already absorbed the heavy lifting phase of its business cycle, and institutions understand this math very well, knowing that markets do not reprice gradually, but reprice violently once profitability becomes visible. The cash burn narrative is dead, but the market has not read the obituary yet, and this lag in perception is exactly where the opportunity lies for those who understand that lean operations and capped spending are the precursors to an explosion in net income. Turning our attention to the charts and market psychology, the technical fortress that has been built around the stock confirms exactly what the fundamentals are suggesting, which is a massive period of accumulation by institutional players who are keenly aware of the value disconnect. The price action on February 3rd provided a textbook example of a shakeout pattern and a classic bear trap, where the price briefly dipped to a low of $4.43, only to stage a dramatic V-shape recover and close near the highs of the session. This long wick on the chart is not just random noise. It represents institutional algorithms stepping in to absorb the panic selling from retail investors, effectively transferring shares from weak hands to strong hands at bargain prices. The $4.40 to $4.50 zone has solidified into a concrete floor of support that the bears have failed to break, signaling that the downside momentum is exhausted. On the upside, the trigger for the next major leg higher is the $4.57 level, and a breakout above this resistance point opens the door to $4.65 and beyond, which would trigger a squeeze on early short positions. We are likely in the midst of a Wyckoff accumulation phase, where the price is being kept artificially low to allow large players to fill their bags before the markup phase begins, creating a coiled spring effect that typically precedes a violent upward move once the supply of cheap shares is finally exhausted. The current environment is not one of clarity, but one of emotional pressure, and that is usually where long-term positions are built, not abandoned. Retail investors are exhausted and tired of the volatility, which creates the exact environment of confused sentiment that large players prefer. History shows that the biggest moves happen when the crowd has given up, right before the inflection point becomes obvious to everyone. The strategy here is to ignore the noise of monthly delivery fluctuations, watch the margins as the explosion in profitability is the real story, and trust the floor, because as long as $4.40 holds, the trend is effectively resetting for a launch. Beyond the financials and technicals, NIO is winning the soft power war through its unmatched brand loyalty and strategic positioning, creating a moat that competitors fighting price wars simply cannot cross. The recent engagement around William Lee's sharing of the cyberpunk Firefly design, known as the Rocky Effect, proves that NIO commands an Apple-like loyalty where users actively create content, design liveries, and essentially sell the cars for the company. This organic marketing is a powerful economic tool that significantly lowers customer acquisition costs, giving NIO a distinct advantage over competitors who must spend heavily to attract attention. While Tesla is forced to spearhead a new round of low-interest financial engineering, offering 7-year loans to combat falling demand and lure buyers, NIO is seeing demand that is organic and driven by a sticky ecosystem that does not require margin-destroying price slashes to move metal. Furthermore, the regulatory environment has handed NIO a massive gift in the form of China's new ban on hidden and electronic door handles, effective for new models in 2027 and existing fleets by 2029. This regulation effectively kills the gadget-focused competitors who prioritized aesthetics over engineering substance, whereas NIO's status as a premium manufacturer with deep R&D capabilities allows it to adapt swiftly. This regulatory shift signals a maturing market that is moving from a Wild West phase to an established auto industry standard, a transition that heavily favors serious engineering-first players like NIO over flash-in-the-pan rivals who lack the technical depth to pivot quickly. In conclusion, NIO is essentially a coiled spring loaded with the tension of improving margins, capped costs, and a technical bottom that is being defended by smart money. The scissors effect is compressing the financials into a profit explosion, and the $4.40 technical floor is providing the launch pad for a repricing event. We are not just watching a stock, we are watching a company transition from a speculative startup to a profitable powerhouse. The window to act before this realization becomes global is closing rapidly. So buckle up, because the harvest phase has begun and the repricing will be violent.